Good evening, everyone, and good evening. A warm welcome to Dhawal Dalal. Dhawal Dalal, Dhawal, it's an absolute pleasure to have you on our sessions today. Just a quick, very introduction to Dhawal. So Dhawal is presently the Chief Investment Officer of Fixed Income at Edelweiss Mutual Fund. He has been working with Edelweiss for the last 5 years plus. Prior to that, he had a very long stint with DSP BlackRock Mutual Fund, where he was the Executive Vice President and Head of Fixed Income for over 18 years. Before joining DSP BlackRock in India, he was a research associate with Merrill Lynch Asset Management in New Jersey, US. He is an MBA from University of Dallas and mechanical engineer from Ahmedabad. A warm welcome, Dhawal.
Thank you, Sujoy. It's a pleasure to be here.
Thank you so much. So Dhawal is all about interest rates, fixed income, and macroeconomy. So Dhawal is an absolute, guru in this space. So let me
We are still learning, Sujoy. After spending 25 years in the market, we are still learning.
Absolutely. Yeah, things are quite, volatile these days. So let's get going. So the topic of today's discussion is an expert session on macroeconomics and interest rates from an expert like you. Let me ask the first question to you, Dhawal. In your opinion, how is the economy performing in the last 2 quarters particularly? How would you would assess it, and how would you overall summarize the situation?
Sujoy, so if you look at the India's economy, one of the things that we are noticing is that it's gradually improving. Okay, so the pandemic hit us very badly, and as you can see that India's GDP declined by about 7.3% in FY21, right? And since then, we are on a gradual recovery. However, as you can see that the economic recovery is uneven, particularly if you compare the GDP growth and rather than comparing year over year, which basically overstates this amount of recovery. If you look at the economic recovery quarter over quarter, this is what the international best practice is, then you probably notice that the first quarter, that is April, May, June of financial year 22, the economy actually declined, okay, year over year. Although the newspaper showed and reports showed that it increased year over year by about 22%, but it's actually declined. Now, going forward, we expect the July, August, September quarter economy to grow at about 24-25% quarter over quarter, seasonally annualized. And then it's going to taper off gradually to show a year over year growth between 9 to 9.5% in FY22. Having said that, I think we will also have to look at what happens to the crude oil prices, because if crude oil prices remain where they are between $80 to $85, then it's going to shave off some of the economic growth that we are going to see. Having said that, I think a number of economists are still sticking to a conservative economic growth projection of around 9% at least. I think a number of international agencies like IMF and World Bank have also been penciling close to around 9%. But going forward, I think while the economic recovery is taking place, as I mentioned, it's uneven. And I think over there, the government is focusing on increasing the capacity of the economic growth in such a manner that the divide that we are seeing between rural and urban and the rich and poor in terms of consumption is breached in such a manner that it's a coherent economy. And as they say, that along with the economic growth, one should also see employment growing as well. So otherwise, it becomes just like a jobless economic growth, right? So government of India doesn't want to do that. So there are a number of policies that are in place. So I think this is where we are. Now, if you break down the economic growth into this normal equation of GDP is equal to C plus I plus G plus X, then what you'll notice is that consumption is picking up, but the investment is still like that. Government of India's spending, I think, has been under control. So what we call the tight fiscal policy, while exports are doing very good. So I think going forward, we will have to see all engines kicking in such a manner that we have a coherent economic growth going forward.
So while there is this, you made a comment about consumption picking up while the government is keeping a tight fist around investments. So where is this consumption coming from? So is it because of some latent demand which was there, or is it some extra money in the hands of the people? What is driving this consumption in your opinion?
So as you can see, Sujoy, the pandemic actually changed the consumption pattern, right? So our economy was pretty much manufacturing plus services, which is worldwide, right? But during the pandemics, the service sector just succumbed because there was no contact which was allowed. As a result of that, suddenly the consumption of manufacturing goods started increasing, right? And because of the pandemic, there was supply shortages and other things. So that resulted in some sort of like a supply bottlenecks. And as a result of that, the consumption has been more in non-durable kind of things. While the durable consumption, durable goods have actually suffered because of lack of government activity or government contract or lack of construction and other stuff. Even so, if you have to look at where the consumption is happening, I think it's broadly categorized as a between rich and poor. I think it's the urban sector, urban rich, those who have a higher level of savings, they are consuming more of goods now initially, and now they are going to shift on services. But at the bottom quartile, you have rural masses which are still suffering. And I think the scars, particularly the MSME sector and the rural population, we are still going to see some more time before their consumption levels come back to the pre-pandemic. But it's more driven by the rich people in luxury items.
So you're saying that presently the consumption that is being seen it's mostly a urban consumption and primarily from the higher household income brackets.
Yeah.
Are you also observing similar? Sorry, please carry on.
No. So that's exactly what I feel is if you go to the bazaars right now, most of the shopping malls and jewelry shops and other things are full with people. Even if you look at the headline article news items about expensive cars or watches, they are in short supply. While the two-wheeler segment, which basically caters to the rural or not so rich people, they are suffering from the sales. So this is what the indications are. That's exactly what I was trying to do. Please go ahead.
Sure. So this is what is really happening in the economy and the kind of behavior that we are observing amongst people in urban areas, which is driving some sort of consumption. At the same time, government is really quite tight-fisted around expenditures. Now, if we have to look ahead, what are the few things that you will be, looking forward or you're expecting to see at this point in time? Could be a natural progression of what we are witnessing.
So I think, in my view, India's economic growth story will have to be charted in terms of first exports and then investments. I don't think consumption is something that is highly encouraged. But right now, as we have seen that apart from India, all other economies have also done very well in terms of getting out of the pandemic-related slump. And as a result of that, there is a boost in their consumption, which I think India can participate through exports, right? And if you look at the past history also, I think whenever there were strong growth cycles, economic growth cycles in India, exports have played very, very important role. And I think from that perspective, I would very expect the exports to once again play a very, very crucial role, number one. The second is investments. While the investment cycle has yet to begin, I think all ingredients are in place for a very robust investment cycle. And the third is the government policies. As you must have seen, the government has been quietly introducing a number of policy measures which are aimed at expanding the capacity of the economy. If you look at the production-linked incentive schemes or the vehicle scrappage policy or many other things that the government has been talking about or planning to do, they are all aimed at expanding the capacity or manufacturing capacity of the country. That in turn will produce more jobs and in turn will support the economic growth, including consumption. So I think investments, and exports. These are the two major engines that I expect India's economy to start accelerating and taking us into the new era. More importantly, Sujay, just one more minute, that the slump in FY21 at 7.3%, right? Even if we are going to grow at 9.5% this year, we are going to be about 6% lower than the pre-pandemic level. I think India's economy will have to grow in terms of real economic growth 7% plus for a number of years in order to be able to meet the trend growth line of 5.5% that we had on pre-pandemic level. And as a result of that, I think both the government of India and the RBI are steadfastly focusing on expanding the capacity of the economic growth.
So there are two things that I think we are banking on in terms of economic recovery from what you're saying, Dhawal, is that one is the consumption boost that the economy is witnessing possibly will continue for now, and the export-led demand, which is
investments and exports.
Investments and exports. Yeah. And what about the private consumption, which is right now there?
See, private consumption has always been there. However, as you must seen that the consumption is a function of the earnings. Now, in the pandemic cycle, there has been a clear diverging trend in earnings. Rich people and the salary class continue to get the salary month after month, while their expenditures have actually reduced because of lack of consumption in service sector. As a result of that, their savings have increased, which is now what is getting converted into what we call revenge shopping, right? However, the working class and the business suffered massively, particularly the MSME and working class, right? And as a result of that, their consumptions have succumbed. Okay, and if there are ample number of indicators that you can see to get the health of their consumption, they are silent suffering. And I think the government of India is acutely aware of the health of the MSMEs and the rural consumer. And as a result of that, they're going to take some time for that consumption to recover. I would say probably with the good monsoon, at least we are on the right path. It will probably take 3 to 4 more months, or maybe by the end of this financial year. We should probably see homogeneous growth in consumption of the rural or the urban poor as well.
Okay. So while there is some decent level of growth which is witnessed now, and maybe the trend suggests that it can continue. However, we need to go to a level of 7% continuous secular kind of growth to go back to the previous trend level. So while there is growth and expectations of growth and so on, obviously with growth comes inflation. And that brings us to the next important topic that's going to be, we'll get into now, is in your view, where are we in terms of inflation? Because India perennially has been a very high inflation economy. Governments have been toppled because of high inflation, while there has been some trend decline in inflation level in the last few years. In your opinion, how do we stack up to our recent history of inflation vis-a-vis the previous last 10-year average?
See, Sujoy, at the broader level, I think this question is very complex. Okay, if we just look at the data and headline data and say, oh my God, inflation, average inflation has been 6.5% last calendar year. This year we are tracking at 5.5% inflation, very, very high. However, I think the important thing is to dig deeper and to find out what are the root cause of this inflation. And in my view, I think the pandemic has actually disrupted a lot of things which were in place, which had resulted in a very, very tight lower level of global inflation, right? Now, number one, as we have understood that the supply disruption, supply side was completely disrupted during the pandemic. Then commodity cycles have also started moving in a different direction. We have the consumer preference, which was shifting from services and suddenly looking to consume more of the durable goods, which were unexpectedly started. So it started putting upward pressure on the demand, and it disrupted the logistics also. So there are a lot of ingredients which have gone into disrupting the benign inflation cycle. Thankfully, the central banks are all same, and they are trying to have a uniform view that these are transitory factors, and it should probably settle down at some point of time. If not in next 2 months, 3 months, probably over 6 months or 12-month period. The good thing is that globally inflation is on the uptrend for either base effect or some of the factors that I have just mentioned. But most of the central banks are going to be sane in not reacting abruptly or out of turn. At best, they are all trying to analyze about their projections, their models, and trying to figure out what best way to address this. Now, as far as India is concerned, we have seen a couple of different trends emerge. So in India, we measure inflation through CPI, headline CPI, right? And there is a WPI. Before 2014, WPI was our main inflation gauge, right? But then later on, because of the change in the policy, now we are shifting to headline CPI, not even core. So we have at this point of time, what do we have in front of us is that the core CPI is about 4.3%. Sorry, the headline CPI is about 4.3%. But if you look at the average inflation for calendar year 2021, you will see that the inflation has been hovering at around 5.5%. The core inflation, on the other hand, has been hovering between 5.5% to 6%, which is sticky. And there's a debate in terms of market participants and economists why the core inflation remains very, very sticky. Because core is food minus, inflation minus food, inflation and energy, right? So there's a core inflation. And I think everyone is scratching the head in terms of why the core inflation continues to remain sticky between 5.5% to 6%.
No, that's a technical issue.
Between 6%, 10% to 11%, which I think, which we have seen in the globally, that the producer level inflation has been very, very high. So eventually, I think, in my view, that the inflation will take some time to settle down and trend lower. I think next year, calendar year 2022, the inflation is expected to be close to around 5%. I'm talking about headline inflation, right? But from the policymakers' perspective, rather than focusing on the inflation, we need to ensure that the economic recovery is in place, firmly in place, on sure footing before you start addressing the inflation. And at this point of time, most of the central banks are just trying to remove the accommodation that they have provided during the pandemic, rather than starting the rate hiking cycle.
So I think you have really opened up a big level of discussion around inflation. So we will continue this discussion. So while the government and RBI is trying to address the growth, they are possibly one eye shut towards inflation, and that is what it appears. So in fact, consciously, and that it could be. Only time will tell us whether what's happening there. We will continue this discussion. There is few questions which have come in. Dhawal, I would like to
happy to answer.
Yeah. So I think the question was previous to that Y plus C plus I plus G example that you brought up. So there is a question which says that in respect to exports, sir, the shift to China plus one policy from foreign market players, how well India has been able to capture the benefit of this, and how do we look at this when China will be back to its full capacity?
See, India is trying to become an alternative to China, right? In terms of appealing to the global manufacturers who are present in China. But if you look at the harsh reality in terms of skill set, in terms of availability of land, labor, and power, and other stuff, I think we are miles away from what China is doing. So I think at least what the government of India has done is taking cognizance of the fact that it's probably, perhaps it may not happen in next year, but next few years, at least a start has been made under this production-linked incentive scheme, in which they are asking global manufacturers to come set up shops over here in a gradual manner, and start building the base among manufacturing base in India in a particular area. Like for example, in China, there is a base for chemical factories. There is a base for furniture, right? There's a huge complex for other stuff, plastic, and so on and so forth. I think India will have to develop similar kind of clusters, and along with the ancillary manufacturing units will be set up to support that kind of. So we are moving in that direction. But as you can see, that India is not China. India is a democratic country, and we will have to do everything as per the proper legal way and channel. So which is going to take some time. But I think at least a start has been made. And based on the projections, some of the research reports that I have read, it has given me a confidence that if these things are put in place, then it will probably add about 1 percentage point more to India's GDP by FY 24-25.
That's huge.
Absolutely. So keeping our fingers crossed.
Right, right. So Chaitanya, that was the response to your question. Thank you, Chaitanya, for the question. We will move on. There is one more question. It's there on the chat box. I don't know whether Dhawal will be in a position to or comfortable responding to that. The question is, at these environments, what should be the ideal mix between equity and debt investments?
See, that question, I think we get a lot these days, right? See, important thing to keep in mind is that during the pandemic, all central banks have cut policy rates, right? And in many countries, we are at zero, and in some countries, is a negative, like never seen before, right? In India, the policy rate was moved from repo rate at 4% to reverse repo rate at 3.35. While the inflation has been above the policy rate, so which we are in an environment called negative real rates, right? And I think in 2020, as I was mentioning, that the average inflation was 6.5%, 6.5%. In calendar year 2021, we are going to be 5.5%. Next year also, our projection is that the average inflation is going to be close to 5%. So if you assume that repo rate remains where it is, and gradually RBI shifts policy rate from reverse repo to repo at 4%, I think in India, we are going to see 3 consecutive years of negative real rates, purely from a policy rate perspective. We are not talking about comparing inflation with 10-year GSEC or any other, just policy rate, right? And when you have this kind of environment, that's when there's something called fiscal repression, financial repression. That's savers are no longer able to enjoy the kind of reward that they expect for their savings. As a result of that, we have seen dramatically different behavior among savers, such as moving into some other alternative investments like equity, real estate, gold, and some other niches. And I think purely now that interest rate cycle is going to turn sometime during the next year, what we are going to see is that in the bond market, investors should expect a low single-digit return. I think in calendar year 21, we are going to see low single-digit return after a blockbuster return in calendar year 20. And calendar 22, next year also, it is my expectation that the bond market will continue to offer low single-digit return to investors. On the other hand, while equity is not my subject, but we are very, very bullish on India's economic growth perspective, and we have just discussed about that. And assuming there is a positive link between economic growth and the equity markets, then I think it's perhaps fair to say that over a long period, I think investor wealth will be more made in equity market than the bond.
Yeah, so there was this follow-up question, Dhawal, that around retail investors, so they are pumping money in the equity market, and if we are expecting low single-digit returns from the debt segment, does that mean that more money will move into riskier capital?
Well, see, as long as retail investors know what they are doing, and right now on the TV, there are a lot of fintech kind of apps out there which basically help investors make the right decision, and while adding into the pool of retail investors who are likely to participate in the equity market. I read a report which basically gave me an impression that in the past, whenever the retail investors' participation in equity market used to go up, and most of the time the demat accounts were opened from metro cities, which was quite well known fact. Recently, in the last few months, we have been very surprised to note that bulk of, I think, 2/3 of the new demat accounts have opened from B30, B15 cities, which basically means that now investors in the hinterland or smaller cities are now coming into the equity markets in search of better returns. And I think while I assume that there is no leverage on the back end, and they are only using their own capital and doing sensible investments for long term, I am very, very positive that the SIP route of investment in equity has been a proven success and a wealth creator. And I hope that retail investors stick to the SIP route, either through mutual fund or through index funds or through other measures, rather than dabbling into unknown equity names in money.
So this negative real rates has been one of the big deterrents for most savers, and that's pushing money out of the debt segments and into equities. And that's what you're saying, that more retail investors. And we are seeing negative real rates in many other parts of the globe as well. How dangerous it is for the entire savings fragment of the world? I
don't know if it could be classified as dangerous. I think it's the right tool given the circumstances. During the pandemic, we saw that the world came into that what you call it great shutdown, right, for 6 to 9 months, and during that the economic activity just succumbed. Now, in order to kickstart the economy, it was imperative that the interest rate were brought down to almost zero, and there is ultra loose monetary policy along with ultra loose fiscal policy. So there's a potent combination of loose fiscal policy and loose monetary policy that basically has helped a number of developed market economies to get out in a much faster manner than what was earlier anticipated. Now, in India's case, because our fiscal situation was not very rosy, I think the government of India decided to sit tight. And that's why we haven't seen the kind of response, fiscal response, the kind of response that we have seen from other developed market governments in terms of spending money. So while our total fiscal deficit went up, partly because of reclassification of some of the off-balance sheet items, but by and large, I think our support to the pandemic level was about 2.5% of the GDP in terms of fiscal support. Now, I think so bulk of the pressure was taken by the central bank in terms of supporting the economic recovery and getting India out of the pandemic hole. At that point of time, getting the borrowers to start borrowing, readjusting the restructuring of the existing loans, or asking some of the worthy investors to start borrowing and see if they want to expand the capacity. This lower interest rate was the need of the hour. And I think that has worked very well across the board. I think most of the economy, as global economies, are out of the hole that they have seen during the pandemic. And now it's perhaps the time to unwind that in a gradual manner. So as long as central banks are aware that the tool has served its purpose and now it has to put back into the bag and start looking at the another tool bag, we are going to see this kind of policy to change over next number of months going forward. But it's a very useful tool at that point of time. Now it has lived its purpose, but the central banks will have to be very, very gradual. I don't think that they can take any risk or an abrupt change in their policies. And this is what we are hearing from most of the central banks. I think they are talking and jawboning and preparing the markets for the upcoming change, including the Fed. Now, recently we have seen the Bank of Canada, Bank of England, even South Korean central bank Bank of Korea, and now Australian Central Bank doing the same. So preparing the market well in ahead so that there are no abrupt changes or disruptions.
So when we were discussing inflation and interest rates, you made some comments around money moving into equities, real estate. So that brings us to the next question, is that mortgage rates and your view on interest rates. So that is something which really affects general people in our country. Mortgage rates are in their mid 6%, right? So it's
never seen like this before.
Never seen like this before. Possibly the lowest was somewhere in 2003-4 in the range of 7.25%.
Absolutely, yes.
So it's been like 2 decades almost from there, and we are once again at those levels and 100 basis points lower. Where the government of India is borrowing money at the rate of maybe annualized 6.5 or something, and the retail is able to borrow at the rate of 6.5. What's your view on interest rates, given where inflation is, and where do you think RBI would be? And you said RBI is going to be really very patient, in fact, all central bankers. So what's your view on interest rates, particularly your view on mortgage interest rates?
So Sujoy, what we are noticing is that while inflation has been a cause of worry, right? And from, as I mentioned, from a core inflation perspective as well as WPI perspective. And now there's a lot of chatter about US changing their policy stance, and the number of rate hike expected over the next couple of months is going to go up and this and that. As far as India is concerned, because the market participants have enormous faith in the conduct of the RBI, I think the linkage between inflation and interest rate has weakened. I think the market participants are able to realize that this inflation that we are seeing is not because of the demand pull, which is what a dangerous component of inflation is, but because of the supply constraint. Now, I don't think anybody out there will probably be able to make a case that RBI raising rates by 1 percentage point will have any impact on the crude oil prices in the global markets, right? Or a food prices, or a drought in Brazil. I don't think that monetary policies are effective on certain circumstances which are contributing to higher level of inflation, particularly on the commodity side or a logistics side. Or it's a change in the monetary policy is not going to introduce or induce a particular driver who's sitting at home with his family worried about COVID infection to come out and start plying his truck on the road. So we are in a different time period, to be honest. And I think that linkage between higher inflation, which is because of various reasons that we discussed, and interest rate. So as a result of that, as I was telling you, that this financial repression, we are at such a beautiful time period as far as some of the mortgage borrowers are concerned, that they are able to borrow money for 10 years, 15 years at such a low level. While in some banks, we have seen not some long ago that even savings rate they were offering 6%, right? So from that perspective, the curve is extremely flat. That you are borrowing, you are earning your savings is earning 6%. We are borrowing 10-year, 15-year money at 6.5, 6.75, 6.80%. So these rates are here to induce those fence sitters to come out and create a capital asset, right? Because real estate, as you know, in India, there is a vast potential for people to own home. And you can see that in India, 2/3 of the population is aged less than 30. So we are at the cusp of the demographic dividend. And all these aspirational people would like to have a better home or a shelter. And at some point of time, our housing stock is not sufficient. I think we will have to keep growing. And these softer mortgage rates are at the perfect level to create that kind of inducement for those people who are seeking a shelter to go and borrow and support a number of activities like real estate supports cement demand, steel, furniture, electricity, tiles, furnishing, and labor. So I think just by creating demand for real estate, we are in a position to create a number of jobs, which in turn will create wider distribution of capital and transmission to economic activity.
So as an investor, Dhawal, personally, are you more bullish on Indian equities or Indian real estate?
I would probably be more into financial assets, having already have invested in my real estate. I am always believer of having a liquid financial assets as compared to real estate.
Sure, great. So let's move on. So while we are in a phase where Indian economy, there is some pickup in investment-led demand, some consumption in some pockets, and the exports market are holding up, and low interest rates are possibly here to stay, and you feel that as a path tool, negative real rates is something which is quite effective. In these situations, so we did discuss, you brought it out that asset markets obviously behave where depending upon where the interest rate levels are. Is there some pattern that you do expect over the next few years that with the negative real rates and some pickup in growth, the asset markets are possibly going to behave in these manners? So you did mention about debt market being low single digit. Do you have any other continuation of this view about other asset classes?
So, just to summarize, that these negative real rates are not going to be there for an elongated period, right? It's just going to be there in a transitory manner next year. And eventually, central banks, once they are ascertained that economic recovery is on a very strong footing, then they will shift their focus from economic growth, supporting economic growth, to containing inflation and ensuring that it doesn't become broad-based. So eventually, we do expect the policy rate to start moving up in a gradual manner, number one. Having said that, we also believe that the normalization cycle is going to be shallower than the previously thought. I think right now, if you look at the OIS market, I think the OIS, there was a very sharp move in OIS rates in October, which basically means that the market is pricing a faster normalization cycle. However, the central banks and particularly RBI governor has been at pain to explain to the market that they are going to be extremely gradual and extremely slow in terms of normalization, so that there is no disruption. Because I think the RBI is acutely aware that the risk of premature tightening on economy is going to create more harmful effect than a delayed tightening, in my view. So I think they are going to stick to that plot in terms of very, very gradual, very, very slow thing. But we are not going to see a elongated period of negative rates, in my view. I think otherwise savers will grow and then they will take their money out. And then already we have seen that the number of these crypto exchanges are flourishing, and newspapers are filled with the story about kind of volume that they are seeing and things like that. You don't want our economic, our capital, financial capital to go out of the country, right? And I think from that perspective, I think policymakers are acutely aware that there's a level to which you can push savers to tolerate. But as long as they are making money in equity markets, I don't think people are going to complain. So while bond markets are giving them low single digit kind of returns, as long as equity markets continue to offer a decent return over a longer period, I don't think people are going to complain as such. But as far as the trend is concerned, I think in India, one thing that we have learned is that things keep changing, and there are always new factors which are affecting the story and the thought process, right? So this time around now, the emerging theme is that old economy versus new economy. We have seen in the last few months, the new economy getting a huge premium, whether it's Zomato or any other companies which have recently come. Look at Tesla. Now they've crossed $1 trillion market cap, right? As I mean, much bigger than the remaining old economy kind of thing. So one of the trend that probably we are going to see is the continuous debate among investors between whether how valuable the new economy is versus where is the value in the old economy. And I think growth versus value is a similar debate versus old economy versus new economy. So we are going to see tremendous opportunities, in my view, for investors to take sides in this debate. and take appropriate positions in that portfolio.
Great. So old economy, new economy. I think there are quite a few questions which are flowing in, Dhawal. So let me just ask you one by one. I think there is a question on the oldest asset, in fact. So their question is, sir, could you throw some light on gold as an investment?
So, Sujoy, I think generally this time around, gold prices haven't gone up, right? And everyone is scratching the head.
One year has been stable, yes.
Yeah, so generally, the gold is probably considered as the oldest hedge against the inflation, right? This time around, while inflations have been trending higher, at least for various reasons, I'm not talking about cost, but the gold prices have remained very, very stable, haven't reacted as such. As a result of that, people are wondering whether the gold has lost its linkage with inflation. Our sense is that this time around, the gold hasn't moved up primarily because there is a new kid on the block, which is called Bitcoin, right? And that has created or garnered a disproportionate amount of investor attention, moving from $40,000 to $60,000 up and down, and every day there's a 3 to 5% percentage point move in the price, right? So gold is sitting on the sideline, waiting for its day in the sun. And I reckon that it's not going to be a day in the sun, but I think gold as an asset class is something that investors can consider for 5 to 10 years or even longer period. The reason is that while the fiat currencies are out there, and I think central banks have pumped so much of money in the last few years, that at some point of time, they are going to start losing their value. And that's why perhaps investors will probably focus on real assets, right? Like land, property, gold, silver, anything that they can get their hands on, which is tradable and liquid in certain manner. So I am fairly confident that gold will do well over a period of time, nothing immediate. And in India, we have started seeing gold imports have started rising in the last 3 to 4 months. 2 weeks ago, I had visited Tanishq showroom in Andheri, and I was very surprised at the kind of buzz among investors. And it's not a wedding season yet, but the gold consumption is rising, and I think, in my view, the gold prices are bound to go higher over the next 5 to 10 years. That is on the demand side. From a supply side's perspective, what is important to note is that there is very little investment being made in increasing the supply of gold. And that is perhaps true for many other commodities, whether it's copper or aluminum or zinc or any, and that's the symptomatic of what we are seeing recently in terms of wild upward movement in prices because of the increasing demand. That there is no commensurate increase in the investment cycle. So as a result of that, we are going to see, as long as these investments are not being made, the moment demand picks up, you are going to see exponential increase in prices for gold.
Oh, that's very interesting. Very interesting.
But I'm a bullish for over next 10 years, not next 1 or 2 years.
Yes, we take it with that caution. Yes, absolutely. Quite a few questions, Dhawal, flowing in. So the next question is on the Indian banking private banks. The question is, what are the Indian private banks planning for the next 7-10 years with low interest rates and gradual normalization of markets?
See, India is still an underbanked country, right? And my sense is
sorry to interrupt. I think that the continuation to that question is, what's your view about the decentralized financing? So
DeFi. Oh my God.
DeFi.
We need to have another session on discussion on DeFi itself. But see, let me address to the best of my knowledge. Okay, I'm still a student of DeFi and blockchain and Bitcoin and other stuff. But Few things from my perspective is that India is still an underbanked country, and I think the government of India and the RBI are trying to ensure that there is an access to a bank for most of the investors. That's number one. And in light of that, they came out with this small finance bank model and a payment bank kind of model, just to ensure that there is an access to urban or in India to a bank. However, in my personal view, this payment bank model hasn't worked. Even small finance bank model is struggling, primarily for deposit creation, because investors haven't found comfort with their hard-earned money to hand over to a small finance bank that they have not heard of for quite some time. So as a result of that, we are seeing that although small finance banks are very well capitalized and they are all controlled by RBI or governed by the RBI, they are taking time to grow their books. And this pandemic has also hit them. And I think a number of small finance banks were actually converted from microfinance. So there's a legacy issue that they are also facing. And that creates a huge room for some of the well-capitalized old private sector banks to make inroads into the rural areas of India and collect very high level of stable CASA assets. And that in turn will probably promote their growth, because now in India, with so much of internet connectivity and so many smartphones available with people, I think banking is at the cusp of going digital. I think most of the today's newspaper said that the UPI transaction in October was 7 trillion rupees, one of the highest ever. And I think people are getting more and more comfortable using digital transactions for shifting for their day-to-day consumption. And from that perspective, I think banks will be able to convert their clients into using various other digital services. So that will reduce their cost of operation and in turn will improve their net interest margin and profitability immensely. So I think this is something that we are very focused on. Separately, I think the government of India is also trying to ensure that in India, banks attain certain size. Because if you look at the top 10 largest banks in the US or in the world, I think they have enormous balance sheet size, right? And our largest banks don't feature anywhere close to their sizes. So for economy to grow and for economy to be able to fund large capex cycle, one of the primary needs is to have a very strong and robust banking system, very well capitalized and very large asset base, which can support the huge funding needs of the economy, right? So from that perspective, I think the government of India is also acutely aware that they need to do something about it, and they need to create or allow banks to merge or do whatever to create very strong capital base and large balance sheets. So we are going to see some activity in that area.
Great. I think this is such a engrossing subject. So there are actually quite a few questions which are getting posted for this. Now in this normalization period, and where you say that India is still an unbanked thing. So there is a direct question. What's your view about this PSU banks for investment, as an investment?
So Sujoy, as you may be aware that we normally don't provide any kind of advice on equities selection. But as a process, as a policy process, I probably feel that it's an appropriate decision in case if the government decides to do that in terms of converting a PSU bank into a private sector bank. I think it's about after 70 years that this nationalization is undone. And I think, as you know, that number of PSU banks are trading at below 1 price to book ratio. And if some reason, if they are able to modernize themselves and get into a new avatar and improve their efficiency and capital allocation and other factors, I think there's enormous value creation waiting to happen. If you look at the average price to book of ratio of some of the private sector banks, and if you look at some of the average price to book ratio of a PSU bank, there's a huge gap. And over a period of time, assuming that the government of India is able to do the right things, and there's a less resistance from the union and other participants, then I think there is enormous value creation likely to happen.
So there is a follow-on question to this low interest rate environment and the comment around money possibly moving into equities. So the question is direct. The question is, sir, my question is that how can we say that this is a bull run in the stock market while our per capita income in India is lower than that of Bangladesh? Unemployment rate is all-time high. Population is increasing and limited resources in our country. Isn't this a bubble in our stock market which may burst and very soon and the Nifty is back to 10,000?
So Sujoy, I think this is a perennial question about the disparity, okay? And this is the debate that has always resurfaced between the Wall Street and the Main Street, okay? And we are very, very sympathetic to this view that, and the government of India is also sympathetic to this view, but it's important to note that it's not either or one against the other, right? In general, a stock market is a reflection of the confidence that people have or investors have in the economy. And if the economy does well, then the rich fruits of economy is going to be shared by everyone. And I think it will help people get out of the poverty line or increase their wealth over a period of time. So I think while our per capita income of $2,000 is slightly closer to Bangladesh, it must be noted that Bangladesh has made rapid stride in changing their economic models and policies. And as a result of that, Bangladesh has had benefited from the global exports boom. And as a result of that, their wealth have increased. I think Bangladesh is a very classic story about how they have benefited from the garments exports, right? And there are stories about how Bangladeshi women have joined the labor force and supported their families to increased income. And that has in turn contributed to higher per capita. I think India is probably now moving in the same direction, getting its act together. And over a number of periods, I think we are going to see a similar uptrend in our per capita income. And I think if we keep doing the right thing and don't make any policy errors, my view is that we are going to see exponential growth in per capita income, assuming that our population remains where it is, while our economic growth moves faster.
Population remains where it is could be it's getting tested actually. So we are ballooning.
No, in fact, worldwide there is I think population is stagnant, and in my view, the fertility rate is dropping. So I think from that perspective, although we haven't done our latest census yet, but I would probably feel that the fertility rate of I think now is less than 2.
Right. So we are in the last few minutes of the session, Dhawal, and the question to you is your recommendations to the present RBI governor and finance minister.
Who am I to give recommendations, Sujay? I think the Reserve Bank of India has earned tremendous respect from the investors through their conduct and giving assurances during difficult time. I think this present leadership of the RBI, and I'm very thankful to the government that they have given extension to the present governor for additional 3 years, right? And I think this in turn, you will probably provide enormous confidence to foreign investors as well. that there's a continuity, particularly at a time which was very, very crucial. That now the pandemic is over, we have steered the economy out. Now you need to move in the right direction. And for that, having a stability in the central bank is extremely important. And I'm comparing this with the Fed, where Chairman Powell is waiting for his confirmation, whether he doesn't know whether he's going to be confirmed next year or not. And I think so this probably to a certain extent adds a premium in terms of yield that foreign investors or investors generally demand. So from that perspective, that uncertainty is out. I think the premium is going to be not there in my view. And I think the RBI will have to continue to engage with the investors and keep doing the right thing in my view. Having said that, I would probably like to request the RBI governor, if I can, through your platform, that I think in India, as you can see, that mutual funds assets have grown very, very nicely, right? Now almost about 37 trillion rupees of total assets as on September 30th. And I think the fixed income assets are also now almost 16 trillion rupees. I think it will probably be appreciated if RBI will take into account the rising fixed income assets of mutual funds and allow mutual funds to participate in their day-to-day life and other repo operations. That will be really, really helpful, because right now, so far, I think the Reserve Bank of India has kept these LAF operations and reverse repo operations pretty much close-knit and only accessible to banking system. What we are observing worldwide is that because even in the US, mutual funds have become very, very powerful and very, very, very strong and a counterforce to a banking system. Even in the US, now that the overnight rate operation that the US government or the Federal Reserve is starting, they are allowing US mutual funds to participate in the day-to-day reverse repo operation. So that will help them measure the excess liquidity and take appropriate decision-making process. Similarly, I think Indian mutual funds, fixed income mutual funds being net lender to the system. I think if the Reserve Bank of India allows mutual funds to participate in these day-to-day reverse repo operations, even for a limited time period, I think it will result in a very higher, improved returns for investors, and in turn allow the Reserve Bank of India to understand greater about the total pool of liquidity that they are trying to manage. That is my wish list this Diwali.
Absolutely. So we will tweet this and we will let the RBI governor and Nirmala Sitharaman know about this. So that brings us to our final part, that we were discussing, money, regulations, how effective RBI governor could be in these systems, how the economy is functioning. But while all of these things were happening on one side, there has been this emergence of this blockchain technology, which has been disruptive for many sectors and has been quite threatening to the financial system as well. And with the advent of DeFi, decentralized financing, so we don't know whether RBI will have a control on that, will not have a control on that. And then with that, obviously, the importance of the banking system for our transactions between one entity to the other entity comes down. In your opinion, Dhawal, what is happening in this space? If it is going to be disruptive at all, or will some sanity come in and there can be some regulations, where are we headed from a financial system perspective?
So this blockchain technology, Surya, again, I would like to reiterate that we are all students of this new technology. It's very exciting, to be honest. And I think it's going to be a next frontier in terms of development of finance and the transaction, cross-border transaction, in terms of safety and other things.
Sorry, we lost you in between, Dhawal.
No, I'm saying that this is likely to be a next frontier in terms of technology.
Sorry, we lost you in.
Am I audible?
Yes, Dhawal, you're audible. Sujoy, I think you may want to check your connection. Can you hear us, Sujoy?
Yes, I can hear you.
Okay,
Yeah.
awesome. I think we're back on track.
Yeah. So, Sujoy, what I was trying to tell you is that, in my view, the blockchain is going to be a next frontier of technology that will probably propel the cross-border transaction in a very, very efficient manner, and in turn will bring economies to scale, economies of scale to the transaction. Having said that, I think it's probably close to, we are probably close to this 486 Intel chip, if you remember, in terms of understanding or at least evolution process. So from 486 now we are to core, 8 core or even higher chip development, right? So that journey over the last couple of years have been very, very exciting. So in my view, I think blockchain technology is also going to emerge in a similar manner. Having said that, I think it's important to note that no government will allow their central banks to lose control of their financials or their currency, right? So my view is that there will be, just like right now we have a global standard emerging for environmental and climate control. We probably will see similar kind of a global standard for decentralized financing in terms of at least from a rules and regulations and compliance and reporting perspective. Because while the word decentralized finance sounds like there is no control from nobody, I don't think that the government and the central banks will be very happy to have no control over who does what and how it's being done. So we are at the extreme point, and I think we will have to converge in terms of such a manner that there is a convergence in terms of expectations and demand. And in terms of rules, regulations, compliance, reporting, and many other things, in order to be able, government and policymakers to be comfortable allowing people to transact through decentralized financing. But I think as a concept, I think it's not going to go. And I think everyone, including your students, perhaps have a great opportunity to come up the learning curve in this very, very upcoming technology, which is going to be a game changer.
Absolutely. So we get the bulk of the questions around this space of cryptocurrency and blockchain technology and so on. Wonderful. Let me just go through and see whether most of the questions have been addressed. I don't know whether you want to take it, but there is a question that Dhawal sir, do you see technical charts of stock while picking it?
Sujoy, I am not investing in direct stocks. I am a firm investor through mutual funds, and all my investments are in equity mutual funds only. And one of the ways I do it is through SIP. So I'm a firm believer that wealth creation, SIP is the best mode of wealth creation. And while I use technical charts for my bond yield projections, I'm not using it for equity investments, because I am an equity investor for a long period. And I normally believe that as long as India's economy will keep growing and the policies makers are making the right kind of policy choices, I think there is going to be wealth creation for generations to come.
So there is one last question for you. It says, Dhawal sir, where do you see Nifty in the next 5 years?
As again, as I'm telling you, it is difficult to make projections, but I can be fairly confident that if our economy keeps growing at 7% plus real rate for next couple of years, and the fruits of good policies are being reaped by our corporates, their profitability will keep improving, and their efficiencies will keep improving. And as a result of that, we are going to see at least 10% kind of growth per year in Nifty, which I think will be more than sufficient for value creation and wealth creation.
Super. So I think that brings us to the end of this today's session, Dhawal. It was absolute delight. But before we let you go away, I want to talk to all the students and remind them to please take out time to fill in the feedback form about what you felt about today's sessions and anything that you have possibly missed asking us during this session. You're always free to write into us, and we will forward your questions to Mr. Dhawal Dalal. And time permitting, he will surely respond to your questions.
It was a pleasure, Sujoy, to be part of your fireside chat. I really enjoyed the conversation, and I wish you and your students a happy Shubh Deepavali and Nutan Varsha Abhinandan in advance. Happy investing.
Thank you so much, Dhawal. I'm wishing you all the very best.
Same here.
Great. Thank you, Dhawal. With that note, we wish you a goodbye for now. And I think there is enough and more to discuss with you. We would keep extending our invitations to you, and we possibly will have you back in our classroom once again.
Happy to be
Thank
part
you.
of it. Okay. Bye-bye.
Bye-bye.